Welcome back to the deep dive. Today, we are doing something that feels a little bit like eating your vegetable.
Yeah, that's a good way to put it.
You know it is good for you, you know you should do it, but, you usually end up just pushing it to the side of the plate to get to the dessert.
That is a very charitable way of putting it. I would say for most people, today's topic feels less like eating vegetables and more like reading the terms and conditions
Yeah.
for a software update.
Oh, that's a better one.
You just scroll and scroll. You see pages of what looks like just legal text. You tick that little box that says, I agree, and you just pray you didn't sign away your firstborn child.
Or agree to let some company record your dreams or something equally weird.
Exactly.
And that's what we're talking about, the paperwork, the documentation, the fine print of mutual funds. But
Yeah.
I want to flip the script on this immediately. Let's not look at this as just bureaucracy or, red tape. I want to use an analogy. Imagine you just went out and bought a high-performance sports car. Or maybe an incredibly complex professional-grade camera.
Okay, I'm with you. A complicated piece of kit.
Exactly. You wouldn't just toss the owner's manual in the trash, would you?
I mean, some people might, but no, you shouldn't.
You'd want to know what that weird red flashing light on the dashboard means. You'd want to know the maintenance schedule so the engine doesn't, blow up on the highway.
Right. You need to know how to operate the thing you just spent a ton of money on.
In the financial world, the documents we are discussing today, the SID, the SAI, the KIM, that's your manual. It is the owner's manual for your wealth. And if you don't read it, you don't actually know what you bought.
And that's the key difference.
How so?
Unlike that camera, if this investment breaks, it takes your retirement savings with it. This isn't just a hobby. This is your future.
That is the reality. It's a sobering thought.
And to really validate that, I want to bring in a legal principle right at the top. It is explicitly mentioned in the source material, and it really sets the stage for why we are having this conversation.
Okay.
Caveat emptor.
Let the buyer beware.
Precisely. Let the buyer beware. We often think of mutual funds as these managed, safe products where a smart person in a suit handles everything for us, which is partly true, but legally.
Legally, what is it?
It's a contract. When you sign that application form, or more likely when you click Invest on an app, you're entering into a binding legal arrangement.
I don't think people think of it that way.
They don't.
Yeah.
But you are essentially telling the regulator and the fund house, I've read the offer document, I understand the risks, and I accept the terms of this offer. You're attesting to that.
So if I lose a bunch of money because I didn't understand the strategy, say I bought a super volatile small cap fund thinking it was as safe as a savings account, I can't go crying to the regulator saying, but I didn't know.
You can't, because you signed a piece of paper,
Yeah.
digitally or otherwise, saying, I do know.
Wow. You signed the contract blind.
So our mission today is to take the blindfold off. We are going to decode Chapter 5, scheme-related information. We're going to break down what I call the holy trinity of mutual fund documents.
Okay. The Holy Trinity, what are they?
The SID, the SAI, and the KIM.
The acronym SOUP starts early today.
It does, but we will decode them one by one, I promise. We are going to look at why these documents exist, how to spot if a fund is changing its DNA, its fundamental attributes.
I like that. It's DNA.
And my personal favorite, we're going to talk about the riskometer.
The riskometer. I am excited for that because I saw in the notes that the regulator has mandated some very specifically named colors.
Oh, they are very specific.
We aren't just talking green and red. We are talking Irish green and caramel. Who comes up with this?
It is oddly specific, isn't it? But there's a good reason for it, and we will get into why that really matters for investors.
All right, let's unpack this. Let's start with Section 1, the primary documents. I think most listeners who have, dabbled in stocks have heard the word prospectus.
Sure, the common term.
When a company goes public, they issue a prospectus. It's that big book that tells you everything. Is that what we are dealing with here in mutual funds? A single, giant document?
In spirit, yes. The idea is the same. It is the offer document. But in the Indian mutual fund context, the structure is, well, it's unique. You don't just get one book.
Yeah.
The prospectus is actually split into two distinct documents that legally must be read together.
Two documents. That seems like it complicates things right off the bat. What are they?
You have the SID, which stands for Scheme Information Document.
SID, got it.
And you have the SAI, the Statement of Additional Information.
SID and SAI. Why split them? Why not just hand me one giant PDF and call it a day? Why make me download two things? It feels like extra work.
It does, but it comes down to efficiency and structure. Think about how an asset management company, an AMC, is built. Let's say we have the deep dive mutual fund house.
I like it. We're in business.
We might run 50 different schemes. We have a large cap equity fund, a liquid debt fund, a gold fund, a thematic IT fund, and so on.
Okay, right. We are a big fund house with lots of products.
Now, there is a lot of information that applies to the deep dive mutual fund house as a corporation.
Hmm.
Who are our sponsors? Who are the trustees watching over everything? What are the legal grievance mechanisms? Who is the custodian physically holding the securities?
Right, that's the corporate plumbing.
Precisely. That information is static. It
Yeah.
doesn't change whether you buy our equity fund or our debt fund. It's the same for all 50 products.
Okay, that makes sense. The corporate structure is the same regardless of what I'm buying from you.
Exactly. So instead of printing those same 50 pages of corporate details in every single scheme document, which would be a huge waste of paper and digital space,
Hmm.
the regulator allows them to strip it out.
And put it somewhere else.
They put it in a master document.
Yep.
And that master document is the SAI, the Statement of Additional Information. It is the corporate profile that applies to all schemes under that AMC.
So it avoids redundancy. That's actually pretty smart. So what is the SID then?
The SID is the specific product manual. It is unique to the scheme you're considering. So if you are buying the deep dive equity fund, the SID for that fund tells you about the stocks we buy, the specific risks of equity, the fund manager for that specific fund, and the fees for that specific fund.
It's the nitty-gritty.
It is all the operational detail for that one product.
I like to use analogies to keep these things straight in my head. Let's try one. Imagine a university.
Okay.
The SAI is like the university handbook. It lists the general code of conduct, the board of deans, the sexual harassment policy, the library rules, the holiday schedule, all the big rules.
And those apply to every student on campus, no matter their major.
Exactly. Whether you are studying physics or French literature, the library hours are the same.
That is a perfect parallel.
And so the SID must be the course syllabus. It is specific to Physics 101. It tells you what textbooks you need, how the grading curve works for this class, what the prerequisites are, and what you are actually going to learn week by week in that specific room.
And to carry that analogy to its conclusion, you need both. You need the handbook to know the university is legitimate and safe, but you need the syllabus to actually pass the class.
You can't just read the syllabus and ignore the university rules on plagiarism.
Right. And you can't just read the handbook and expect to pass physics. You need both to be a fully informed student, or in our case, a fully informed investor.
Now, I want to touch on something that I think confuses a lot of people. When we see these documents, these SIDs and SAIs, they look incredibly official.
They do.
They follow a strict format prescribed by SEBI. They have dense legal language. It is very, very easy to assume that because SEBI, the Securities and Exchange Board of India, is the regulator, that SEBI has approved these documents.
Like they've given it their blessing.
Exactly. Like they've stamped them with a SEBI certified good investment seal of approval.
I am so glad you brought this up because this is one of the biggest and, frankly, most dangerous misconceptions in the market.
So they don't approve it.
The answer is an emphatic no.
Wait, really? But they are the regulator. What are they doing if not approving?
The source material is explicit about this. If you look at the cover page of any scheme information document, there is a standard disclaimer clause, usually in bold print. It says, in no uncertain terms, that the units being offered have not been approved or recommended by SEBI.
That feels completely counterintuitive.
It does, but it's an important distinction. SEBI vets the documents. They provide observations.
Okay, what does that mean in practice?
So the mutual fund drafts the SID and sends it over to SEBI. SEBI's team reads it and says, hey, your risk disclosure in paragraph 3 is too vague. You need to clarify it. Or you haven't explained this new fee structure clearly enough for a retail investor to understand.
So they're like an editor.
A very powerful editor. The mutual fund then has to fix those issues and incorporate the observations. SEBI ensures the format is correct and the disclosures are present and clear, but SEBI does not vouch for the quality of the scheme itself.
So SEBI is like a building inspector.
How so?
They check to make sure the wiring is up to code and the foundation is legal and meets all the minimum safety requirements. But they don't promise that the house is beautiful or that the price you're paying is fair or that you will be happy living there.
Or that the house won't lose value next year.
That's exactly right. The disclaimer also says SEBI has not certified the accuracy or adequacy of the document. The final legal responsibility for the truth of the statements lies with the AMC.
Which brings us right back to where we started.
Caveat emptor.
Let the buyer beware. Just because it is a regulated document doesn't mean it is a safe investment. It just means it is a disclosed investment.
Correct. The regulator's job is to ensure you have the information to make a decision, not to make the decision for you. Okay, let's drill down into the SID, the scheme information document. This is the user manual, the course syllabus for the specific fund. If I'm a conscientious investor and I actually open this PDF, maybe on a rainy Sunday afternoon with a cup of coffee, what am I looking for? What are the non-negotiables?
The cover page is your first stop. It's the snapshot. It gives you the basic identity of the scheme. First, the name. Is it the growth fund or the income fund? Second, the type.
And by type, you mean?
Is it open-ended, meaning you can enter or exit pretty much any time? Or is it close-ended, meaning your money is locked in for a fixed period? Very different liquidity profiles.
Right, and then the category.
Third, the category. Is it equity? Is it debt? Is it a hybrid? And if it is a brand new fund, you will see the NFO dates new fund offer. When does the window open to buy in at the initial price, and when does it close?
Standard stuff so far, just the AD card of the fund.
Right. Then you get the contact details for the AMC and the trustee company, which we'll get to. But the real meat of the document, the part that should actually determine whether you write a check or not, starts with the section called Key Components for Decision Making.
I love that title. It is remarkably clear for a legal document. Read this to decide. What is the first component I should look for?
The investment objective. This answers the most fundamental question. What is the point of this money? What is this fund trying to achieve for me?
And what are some common objectives?
You'll see things like long-term capital appreciation. That's code for we are trying to grow the pot of money over 5, 7, 10 years. Or you might see the goal is regular income. That means we are trying to pay you a dividend every quarter or so. Those are two very, very different destinations for your money.
It's like one is planting a forest for your grandkids, the other is planting a vegetable garden to eat from this summer.
Perfect analogy.
If you mix those up, you are going to be very unhappy.
Precisely. If you need money for rent next month, you do not want a fund whose objective is long-term capital appreciation. The next thing you must look at is the asset allocation pattern.
The asset allocation pattern.
I call this the recipe. The objective is the meal. Say we're making a spicy curry. The asset allocation is the recipe card that tells you the ingredients and their proportions. It says 80% chili peppers, equity, 10% water, cash, 10% potatoes, debt.
That sounds like a very volatile curry. My stomach hurts just thinking about it.
It is, and that's the point. If you see an asset allocation that says 80, 100% in equities, you know immediately, without reading another word, that this fund is going to be volatile. It will go up and down a lot. If the allocation says 100% in government securities, the risk profile is completely different. This section gives you the technical breakdown of the risk.
So it prevents the marketing fluff. A fund might call itself Super Safe Future Fund, but if the asset allocation in the SID says 90% in small cap equities, the document reviews the truth.
Exactly. The numbers don't lie. Then, usually following the allocation is the investment strategy.
How is that different from the objective? They sound similar.
The objective is the what. The strategy is the how. Okay, your objective is capital appreciation. How are you going to achieve that?
Give me an example.
Are you a value investor, meaning you're trying to buy beaten down stocks that look cheap? Are you a growth investor chasing expensive, high-flying tech stocks that are growing fast? Do you use a top-down approach where you analyze the economy first and then pick sectors, or a bottom-up approach where you just pick great companies regardless of the economic climate?
This is really where you get inside the fund manager's head, their philosophy.
Yes, it tells you the philosophy.
Yeah.
It matters. If the market crashes, a value manager might see it as a buying opportunity, while a momentum manager might be forced to sell. You need to know which one you are hiring to manage your money.
The source material also highlights risk factors as a major section, and it splits them into standard risks and scheme-specific risks. Help us parse that. What's the difference?
Standard risks are the boilerplate warnings. You will see these in almost every SID for almost any fund. Mutual funds are subject to market risks. There is no guarantee of returns. Past performance is not an indicator of future returns.
Right.
The sponsor is not liable for any loss beyond their initial contribution.
So these are the cover your behind clauses, the generic warnings.
Basically, it is reminding you that gravity exists and things can fall. Scheme-specific risks are where you need to put your reading glasses on and pay close attention. These are tailored to the strategy we just discussed.
Okay, so they're not generic.
Not at all. If you are reading the SID of a technology sector fund, a scheme-specific risk would be concentration risk. Since you only own one sector, if the tech sector crashes, you have nowhere to hide. You aren't diversified across the economy.
And for a debt fund.
You will see credit risk or interest rate risk. Credit risk is the risk that the company you lent money to goes bankrupt and can't pay you back. Interest rate risk is the risk that if interest rates go up, the value of your existing lower rate bonds will go down.
So the specific risks section is where they have to tell you exactly what can go wrong with this specific idea.
It's the difference between saying driving is dangerous, which is a standard risk, and saying driving a motorcycle on an icy road at night without a helmet is dangerous, which is a very specific risk.
That is a very helpful distinction. Okay, before we close the book on the SID, there is one more item the outline mentions, the due diligence certificate. That sounds very formal and important. Who signs that and why do I care?
The AMC signs it, the asset management company. It is a certificate confirming that they have, in fact, complied with all SEBI regulations in preparing the document. It certifies that all the intermediaries, the brokers, the registrars, are legally registered with SEBI.
So it's a checklist.
Think of it as the pre-flight checklist for an airplane. The pilot, who is the AMC in this case, signs a document saying, I have checked the flaps, I've checked the fuel, the landing gear is down, and we are legal to fly. It is the AMC putting their reputation and legal liability on the line, attesting that everything is in order.
Okay, so that's the SID, the deep, deep dive into the product. Let's quickly pivot back to the SAI, the University Handbook. We established it's the corporate profile. But if I actually download this thing, what specific nuggets am I looking for? What's worth my time?
You are looking for the constituents, the cast of characters in this financial drama. First, who is the sponsor?
The one who put up the initial money.
Exactly. This is the entity that set up the fund. Is it a reputable bank with a 100-year history? A large, stable financial institution? Or is it some company you've never heard of that was started last year? The sponsor's track record and reputation matter.
Okay, who's next?
Then, the trustees. We do not talk about the trustees enough in the financial world. They're critical.
So who are they? What do they do?
The trustees are the guardians. Their only job, their fiduciary duty, is to protect the interests of the unit holders. That's you, from the AMC.
Wait, explain that dynamic. I thought the AMC was on my side. Aren't they trying to make me money?
They are. But the AMC is a for-profit business. They want to make profits from management fees. Sometimes the AMC's desire to launch a risky new product or charge higher fees might conflict with your desire for safety and low costs.
So there's a potential conflict of interest.
Always. The trustees are an independent body that stands in the middle. They legally hold the property of the fund, all the stocks and bonds in trust for the investors. They are there to check if the AMC is following the rules laid out in the SID. They're your watchdog.
I see. So the SAI tells me who my bodyguards are. That's a pretty important piece of information.
It is. The SAI also lists the custodians, the institution that physically or digitally holds the actual securities, the registrar and transfer agents, the people who keep the official list of all the investors, and the auditors.
And financials.
Yes. It also contains the condensed financial information of the AMC itself. Is the company that's running my money profitable and stable? And all the other legal stuff. How do you nominate someone on your account? What happens if a minor invests? How do you file a formal grievance if you have a problem? It's all in the SAI.
And where do I find this SAI? Do they mail me a giant physical book?
You have a right to a printed copy if you ask for one. But in 2026, let's be real, no one does that. You can download it directly from the mutual fund's website or from the AMFI website.
AMFI being the Association of Mutual Funds in India. Okay. I'm going to be honest with you. We have spent quite a bit of time now talking about the SID and the SAI. And while I understand they are vital, they sound exhausting.
It can be. They're dense documents.
They are hundreds of pages of legal text. We live in a TLDR world too long, didn't read. Is there a shortcut? Did the regulator give us a cheat sheet?
They did. And frankly, the regulator knows that if they only relied on the SID and SAI, most retail investors would never read a single thing.
I'm glad they're realistic about it.
That is why we have the KIM.
The Key Information Memorandum.
Think of the KIM as the executive summary or the Cliffs Notes version. It is essentially a condensed summary of the most important parts of the SID and the SAI. It strips away all the boilerplate legal text and leaves only the critical data points you need to make a decision.
Is it optional? Does the fund house just provide it if they feel like being nice that day?
No. This is absolutely crucial. SEBI regulations state that the KIM must accompany every single application form. You cannot legally sell a mutual fund unit without providing the investor with the KIM.
So there's no way around it.
None. If you pick up a physical form at a bank branch, the KIM is physically attached to it. If you're buying online, you usually have to click a checkbox saying you've read or received the link to the KIM before you can proceed to the payment page.
What makes the cut for this cheat sheet? What is considered key information?
All the essentials we just discussed. The name of the scheme. Suitability. A simple statement saying who this product is for. For example, this product is suitable for investors seeking long-term capital appreciation.
It sets expectations.
It does. Then you have the risk profile, which is where you'll find the riskometer. We'll get to that. The plans and options. Are you buying the growth option, where profits are reinvested, or the IDCW, or dividend option, where they are paid out? The benchmark index. What are we comparing this fund's performance to? Is it the Nifty 50? The Sensex? And of course, performance.
Yes, the numbers.
This is mandatory in the KIM. They must show the performance history of the scheme. How is it done over 1 year, 3 years, 5 years, and since its inception?
That seems vital. If a fund has been underperforming its benchmark for 5 straight years, the KIM forces them to show me that ugly number right before I sign the check.
Exactly. They can't hide it behind a flashy advertisement showing only their best 6 months. And finally, the last key piece of information is expenses.
The cost.
The total expense ratio. The KIM tells you, in simple terms, how much this fund costs you to own per year.
How often does this cheat sheet get updated? If I'm looking at a KIM today, is the data from 2015?
No, it has to stay fresh. The KIM must be updated at least once a year.
Okay, so we have our documents. We have the heavy manuals, the SID and SAI, and we have the cheat sheet, the KIM. But I want to move to something that sounds a bit more philosophical. The source material talks about the fundamental attributes of a scheme. It sounds like we are talking about the fund's soul or something.
In a way, we are. I like to call it the core DNA of the fund. When you invest, you are investing based on a promise.
A promise?
Yes. If I sell you a large-cap equity fund, I am promising to buy shares in big, stable, blue-chip companies. If I take your money and then suddenly decide to bet it all on obscure cryptocurrencies or tiny, risky microcap startups, I have violated that promise.
You've bait and switched me.
I've changed the fundamental DNA of the product you bought.
So fundamental attributes are the legally defined core promises of the product, the things that cannot be changed on a whim.
Exactly. Box 5.1 in our source material lists 3 pillars that define these attributes. First is the type of scheme. Is it open-ended or close-ended? That's fundamental.
Right, liquidity is a core feature.
Second is the investment objective. What is the main goal and the investment pattern? Are we an equity fund or a debt fund? And third is the terms of issue. This includes things like the liquidity provisions we mentioned, the aggregate fees and expenses, and any safety net or guarantee if one was offered.
So here is the million-dollar question. Can a fund change its mind? Can the fund manager wake up one day, look at the market, and say, you know what? We are bored of being a safe corporate bond fund. Starting tomorrow, let's become a high-risk international equity fund. Can they do that?
It is possible. Markets change, strategies become outdated, and sometimes a fund needs to change to survive or serve investors better. But the regulator makes it very, very difficult. They can't just do it quietly in the back room.
There's a process.
It's a very strict process. Regulation 1815A kicks in.
Regulation 1815A, that sounds serious. What does it entail?
It's all about ensuring that the investor, the actual owner of the money, is informed and given a clear choice. First, the trustees have to ensure a written communication is sent to every single unit holder. Not a generic newsletter, but a formal letter or email specifically detailing the proposed change.
So they have to tell me directly.
They do. Second, they have to take out an advertisement in at least one English national daily newspaper and one regional newspaper where the head office is located. They have to announce it publicly.
So they have to tell the whole world, hear ye, we are changing the DNA of this fund.
Pretty much. But here's the most important part for you, the listener, the part that protects your wallet. The exit option.
An escape hatch.
A free escape hatch. If the fund changes its fundamental attributes and you as an investor don't like the new direction, the fund must give you an exit window.
For how long?
They must give you 30 days to exit the fund at the prevailing NAV without any exit load.
Oh, that's huge, because many funds have an exit load, a penalty if you leave within the first year.
Right. It's often 1%. But in this 30-day window, that penalty is waived. The regulator is saying, This isn't the product the investors signed up for. You must let them leave without punishment.
That's a critical investor protection. Because if I bought a conservative fund and you suddenly turn it into a risky one, that isn't what I agreed to. It forces the fund to let me walk away without penalty.
Correct. And there was a recent addition to the governance norms. The trustees now must take comments from the board and consider them before making such changes. It's a rigorous process designed to stop style drift, where a fund slowly and quietly morphs into something you never agreed to buy.
That is reassuring. It really underlines that idea of the contract we started with. You can't just change the terms of the contract unilaterally without letting the other party out.
Precisely.
Okay, moving on to Section 4. We've bought the fund, we have read the KIM, now we are holding the investment. How do we keep track of what is happening? I feel like in the old days you'd check the newspaper once a week to see the price, but things are much faster now.
Much, much faster. We have moved from a world of periodic updates to a world of near real-time transparency. There are several mandatory disclosures that act like a live dashboard for your money.
And the most basic one is the price.
Yes, the daily pulse of your investment is the NAV, the net asset value.
The price of one unit of the fund.
Yes, but technically it's the book value of the unit. You take all the assets, subtract all the liabilities, and divide by the total number of units. And AMCs have very strict time limits for disclosing this.
What are they?
For a standard fund, an equity fund, or a debt fund, they must calculate and update the NAV by 11:00 p.m. on every business day.
11:00 p.m. That seems late. The stock market closes at 3:3 p.m. Why the long delay?
It takes time. Think about the back-end process. The fund manager has bought and sold hundreds of stocks during the day. The prices of all those stocks have changed. They have to get the final closing prices for every single security in the portfolio. Then they have to calculate the total value, subtract the management fees for that specific day.
They calculate the fees daily.
Yes, the TER is accrued daily. So they subtract that, and only then can they arrive at the final, precise net value. They have to do this with absolute precision, often for portfolios worth billions. 11:00 p.m. is the deadline to get it right, and upload this to the AMFI website.
What about fund of funds? The source material mentions a different time for them. Why is that?
Right. A fund of funds, by definition, invests in other mutual funds. So if I run a fund of funds, I can't calculate my value until the funds I own have calculated their value.
Ah, it's a domino effect.
Exactly. I have to wait for them to publish their NAVs at 11 p.m. So fund of funds get an extension. They have until 10:00 a.m. the following business day to publish their NAV.
That makes perfect logistical sense. What happens if an AMC misses the deadline? Do they just say, oops, our server was down?
Oops, doesn't fly with SEBI. If they fail to publish within the timeline, they have to explain why to AMFI in writing. And they have to issue a press release to the public stating the reasons for the delay. It's a public embarrassment. It signals operational incompetence, which no fund house wants.
We talked about costs earlier. The TER total expense ratio. That's the fee that eats into my profits. Is that hidden away in some dusty annual report?
Not anymore. That's another area where transparency has massively improved. AMCs must prominently disclose the TE on a daily basis on their website and on the AMFI website.
Daily, so I can see the exact expense ratio every single day.
Every single way. And if the T changes, say they decide to lower the fees to attract more investors, or God forbid, raise them, you don't just find out a year later in a report. You must be notified via email or SMS.
That is a level of transparency you don't get in many other industries. Imagine if your grocery store had to text you every time the price of milk went up by 10 cents.
It forces competition and accountability.
Right.
If I see my fund is charging 2% and a similar competing fund is charging 1%, and then I get a text about a fee hike, well, I'm going to think about moving my money.
Now, besides the price, NAV, and the cost, TEER, there is the big question, where is my money actually? What stocks or bonds do I own today? This is the portfolio disclosure.
Yes. This is the full Monty, as they say. For most funds, like equity funds, the full portfolio, and I mean every single holding with its unique ISIN code, must be disclosed on a monthly and half-yearly basis.
And what's the timeline for that?
This has to happen within 10 days of the end of the month or the half year. So by the 10th of February, you can go online and see exactly what your fund owned on the 31st of January.
Okay, but I see you looking at the notes on debt schemes. They are different. It says here, debt schemes have to disclose fortnightly, every 2 weeks. Why the special treatment?
It's a reaction to history. Debt markets can be much more opaque than equity markets, and liquidity can dry up very, very fast. Back in 2018, India had a major liquidity crisis in the debt markets. Some funds that looked perfectly safe on the surface were suddenly found to be holding toxic, unsellable assets.
So it was a confidence issue.
A huge one. To restore confidence and bring more light into the dark corners of the debt market, the regulator said, we need more frequent updates. So debt funds have to show their hand every 15 days, and they have to do it within 5 days of the fortnight ending. It's a much tighter leash.
And if I'm lazy and don't check the website, do I just stay in the dark?
Not necessarily. If your email is registered with the fund house, they're required to push these portfolio statements to your inbox. You don't even have to go looking for it. It lands in your lap.
There's one more disclosure requirement that I think is really cool. It's relatively new, the dashboard.
Yes, the Scheme Performance Dashboard. This is a mandatory feature on every AMC's website now. And the key is that it isn't just a static PDF. It's a dynamic, comparable tool. You can see the scheme's performance versus its benchmark over various time periods. You can see the assets under management, or AUM, the fund manager's details.
And there's a specific requirement about the fund manager, right? This is my absolute favorite part of the transparency rules. It's brilliant.
It is fascinating, isn't it? It's all about accountability. If you look up a scheme on the dashboard also has to show you the top 3 and bottom 3 schemes managed by that very same fund manager.
I love that. So they can't just hide their failures. If a manager has one superstar fund that is up 50% in a year, they will naturally want to put that on every billboard and in every ad.
Of course.
But if they also happen to run 3 other funds that are down 20% and are at the bottom of their category, the dashboard forces them to show the losers right there next to the winner.
Exactly. It prevents what you might call star washing, where they only talk about their successes. It gives you a much more holistic view of the manager's skill. Are they actually a genius, or did they just get lucky on one aggressive bet in one fund? The dashboard helps you figure that out.
Okay, let's get to the most colorful part of the show, literally. Section 5, visualizing risk. The riskometer.
This has been quite an evolution in the Indian market. It's a great example of regulation adapting to be more user-friendly.
I remember the old days. It was just simple color boxes, blue, yellow, brown.
That's right. Blue was for low risk, yellow for medium, and brown for high. It was functional, I guess, but a bit abstract. And brown doesn't really scream danger the way it should.
No, it just makes me think of cardboard boxes.
Exactly. So SEBI decided we needed something more intuitive, something that triggers a more primal, immediate reaction. Hence, the riskometer. It's designed to look just like a speedometer on a car dashboard.
But what I love are the levels. We went from just 3 simple boxes to 6 distinct levels of anxiety.
Nuance is important in risk. The levels are low, low to moderate, moderate, moderately high, high, and very high.
And the colors. The source material gets oddly specific about the names of the colors. It's not just green, it's Irish green.
Yes. For low risk, it's Irish green. Then for low to moderate, it's chartreuse.
Chartreuse. I don't think I even own a shirt in chartreuse. That is a very, very specific shade of yellow-green.
Then you have moderate, which is neon yellow. Moderately high is caramel.
Caramel. That sounds delicious, but apparently in finance it means my money is getting into a sticky situation.
A good way to think of it, high risk is dark orange. And very high risk is, predictably, bright red.
Why do you think they got so specific with the color palette? I mean, why chartreuse and not just light green? It feels almost whimsical.
It's all about standardization and psychology. If every fund house used a slightly different shade of green, it would be confusing. Maybe one AMC's medium risk yellow looks like another's low risk green.
Right, there'd be no consistency.
By defining the exact color codes, like Irish green is a specific hex code, #08A04B, it ensures that a low-risk badge looks absolutely identical whether you're on a website, a mobile app, or a printed form. It builds instant visual recognition. When your brain sees that caramel color, it should immediately register moderately high risk, no matter whose logo is next to it.
Now, is this riskometer static? Like, once a fund is labeled caramel, does it stay caramel forever?
No. And that is a critical improvement over the old system. It is dynamic. The risk value of the portfolio must be evaluated monthly.
Every single month.
Yes. The source material actually shows a great example of this. Imagine a large and mid-cap fund. At the start of the month, its portfolio holds mostly stable large-cap stocks. So the arrow on the riskometer is pointing to moderately high, caramel.
Okay, makes sense.
But maybe during that month, the market gets choppy, and the fund manager sells the stable stocks and buys more volatile mid-caps to chase returns. Or maybe the overall market volatility just spikes. By the end of the month, the math says the fund's risk profile has increased. The arrow now has to move.
So it could shift from caramel to dark orange or even red.
It could.
Sure.
The arrow might move from moderately high to very high. And you get told about this.
I'd have to be looking for it.
You get told. If the risk level changes, the unit holders get an email or an SMS. Alert. The risk level of your scheme has changed from moderately high to very high.
That is a call to action. It forces me to stop and ask, am I still okay with this new level of risk?
Exactly. It keeps you in the loop and gives you the chance to react if the fund is no longer aligned with your comfort level.
Before we leave the risk-o-meter, the source mentions something called a risk band for SIFs. What is in SIF?
Specialized investment funds. These are generally more complex, higher risk strategies. Maybe they use derivatives heavily, or there are long-short funds, things the average retail investor wouldn't typically buy.
So they get a different scale.
Yes. For them, a simple speedometer might not capture the full nuance of their risk, so they use a risk band scale, which is simply level 1 to level 5. It's a different scale for a different, more sophisticated beast of an investment.
Got it. Now let's talk about the document everyone actually reads. The shiny, colorful PDF that lands in your email every month, the fund fact sheet.
Ah, yes.
Marketing document.
Is this one mandatory? Is it part of the SIDSACM trinity? Technically, no. The SEBI regulations don't say, thou shalt publish a monthly fact sheet. But it is such a standard market practice that it might as well be. If a fund house doesn't publish one, they basically don't exist in the market. Every distributor expects it. Every investor wants it.
It's the brochure.
It is. But it's a brochure with some very strict rules.
So what's in it, typically?
It's a mix of the mandatory data we've already discussed, but presented in a more visually appealing way, often with some marketing flair. You get the basic info inception date, AUM, how big the fund is, the NAV. You get a performance relative to the benchmark, the CAGR, or compounded annual growth rate, for 1, 3, and 5 years.
And I notice almost every fact sheet in India highlights SIP returns. That seems unique.
It is, and it's very investor-centric. Since the vast majority of retail investors in India invest via a systematic investment plan, or SIP putting in small monthly amounts, showing the return on SIP is actually more relevant to their real-world experience than showing a lump sum return. It's a very common and helpful market practice.
What about the portfolio? Does the fact sheet show me everything that I own?
Usually, no. Remember, the full portfolio disclosure is a separate mandatory document. The fact sheet often just shows the top 10 holdings or the top sector exposures. It's a snapshot designed to give you a flavor of the fund, not the full, exhaustive audit.
I see a lot of fancy ratios in these fact sheets, too. PE ratio, beta, Sharpe ratio, portfolio turnover. Can we quickly decode those for the listener? If I see a high beta, for instance, what does that mean?
Absolutely. Beta measures the fund's volatility compared to the overall market. The market itself has a beta of 1. If your fund has a beta of 1.5, it means that in theory, if the market goes up 10%, your fund is likely to go up 15%.
But it cuts both ways.
And it cuts both ways. If the market falls 10%, you're likely to fall 15%. It's a multiplier of both pain and gain. A beta of less than 1 suggests it's less volatile in the market.
Okay, what about the Sharpe ratio?
Sharpe ratio is all about efficiency. It measures your risk-adjusted return. It answers the question, for every unit of risk you took, how much return did you generate? You want a higher Sharpe ratio. It means the manager isn't just taking wild, crazy risks to get returns. They're being smart and efficient with the risk they do take.
And portfolio turnover.
Portfolio turnover tells you how often the manager is buying and selling stocks within the portfolio. A high turnover, say 100% or more, means there's a lot of churn. That can be a red flag because it usually means higher transaction costs, which eat into your returns.
That is super helpful. Now, since this is a marketing document, can they say whatever they want on it? Can they put a big banner saying, best fun ever, or guaranteed to make you rich?
Absolutely not. Even though the fact sheet itself isn't mandatory, it still falls under SEBI's advertisement codes.
And what do those codes say?
They say the information must be accurate, true, and fair. No misleading info. You cannot promise guaranteed returns unless there's an actual legal guarantor, which practically never happens in mutual funds. You can't use celebrities to endorse the product. You can't just make stuff up.
So they can't cherry pick data.
They can't. If you say, we are the best performing fund in our category, you better have the official data to prove it, and you have to show it across standard time frames, not just in one cherry-picked 3-month period where you got lucky.
We are coming into the home stretch here. We have covered the documents, the risk, the disclosures, but the world changes. How do these documents stay fresh? We talked about the KIM being updated yearly. What about the big ones, the SID and SAI?
It is a rigorous schedule. For the SID of an open-ended scheme, it must be fully updated within 6 months from the end of the first or second half of the financial year. So basically, every 6 months, the entire document gets a full data refresh.
And if something big happens in between, what if there is a material change, as the source calls it?
Then they can't wait 6 months. They have to issue an addendum. An addendum is like a software patch or an urgent update. It's a legal notice that is physically or digitally attached to the SID.
What counts as a material change?
A big one would be if the fund manager quits and a new one joins. That's a huge deal for investors. That has to be communicated immediately via an addendum, which then has to accompany the KIM. You don't wait 6 months to tell people the captain of the ship has changed.
And the SAI, the university handbook. How often does that get a refresh?
That gets updated within 3 months of the end of the financial year. And again, just like the SID, any material changes, like a change in the sponsors or a new trustee joining the board, must be updated on an ongoing basis. The information can't be allowed to get stale.
So let's try to synthesize this whole deep dive. We started with the idea that investing without reading the manual is dangerous. We have walked through the dense forests of the SID and the SII. We found the shortcut path in the KIM. We looked at the colorful, intuitive dashboard of the riskometer. We've monitored the fund's pulse via the NAV and portfolio disclosures.
And I think the big takeaway is that this structure isn't just bureaucracy for the sake of it. It's an ecosystem of transparency. The paperwork is heavy, yes, but it creates a regulated environment where your right to know is protected by law.
And the fine print isn't the enemy.
In the mutual fund world, the fine print is usually where the safety lies. It's where the promises are legally defined and where the risks are honestly exposed.
I love that framing. The fine print is where the safety lies. Now, before we go, I want to leave our listeners with a final provocative thought. Something from the source material that we haven't touched on yet, but is deeply relevant to this whole idea of reading the docs and understanding what's happening with your money.
Okay.
The source mentions something called a segregated portfolio.
Ah, yes. In the industry, we call this side pocketing.
This sounds like something a magician does. What is it and when does it happen?
It typically happens in debt funds. Imagine a debt fund holds bonds from Company A. Suddenly, there's a credit event. Company A defaults on its payments. They can't pay the interest or the principal back,
So the bond is now basically worthless.
or its value drops to near zero. If the fund does nothing, panic can set in. Investors see the NAV crash, and they rush to redeem their units. To pay those redeeming investors, the fund manager might have to sell the good bonds in the portfolio, which hurts the investors who choose to stay.
So the bad apple spoils the whole barrel, and the people who panic first get out while the loyal investors are left holding a deteriorating portfolio.
Exactly. So to prevent this, SEBI allows the fund to create a segregated portfolio. They perform surgery, they surgically cut out the bad bond from Company A and move it into a separate, quarantined side pocket, the segregated portfolio.
And what's left in the main fund?
The main portfolio now only holds the good, healthy assets. Investors who are in the fund at the time of the event get units in both the main portfolio and the new segregated one.
So it protects the good assets from being infected by the bad ones, and it stops panic redemptions from draining the liquidity of the good investments.
Precisely. It locks the bad asset away until the fund house can hopefully recover some money from it through bankruptcy proceedings, which might take years if they recover anything at all.
But here's the thought for you, the listener. If you opened your monthly account statement and saw a new, strange line item called segregated portfolio appear next to your main fund's name, would you know what it means? Would you realize that it is a sign that your fund just ring-fenced a toxic asset that defaulted?
Or would you just gloss over it, thinking it's some technical jargon?
Exactly. It's just one more reason to embrace the boring, colorful, and sometimes dense world of disclosures. Because sometimes the most important story about your money isn't in the headlines, it's written in the footnotes of your statement.
Couldn't have said it better myself. Read the manual. It really does pay.
That's it for this deep dive. Thanks for listening, and we will catch you in the next